From April 2027, there is a major change coming to inheritance tax. And under the new rules, if you're not careful, HMRC could end up taking more money from your estate than any of your own children. Most people assume their pension is safe from the taxman when they die, and it has been until now. In this video, I'm going to break down exactly how inheritance tax works today, what's changing in 2027, and what you can do right now to protect what you have built. So first, let's look at how inheritance tax works today. When someone dies, the government adds up the value of everything they own: their house, their savings, their investments, their jewellery, everything. This is called your estate. And your estate is what is taxable when you die. I know what you're thinking. You work your whole life to build up all of these assets, and now they want to tax it. And it definitely doesn't sound fair. And if I'm being honest, it's probably not. But do not despair too much. The government do have little levers you can pull to take away some of the sting. And the first one is that not all of it is taxed straight away. There's a threshold called the nil rate band, and that allows some of your assets to pass to your family completely tax-free. Most people get £325,000 each, and if you're leaving your home to your children or grandchildren, you may also qualify for an extra £175,000 on top of that. So in most cases, up to £500,000 can pass to your family without any inheritance tax being charged. So if you're married, this can actually be up to £1 million for a couple. And also assets left to a husband or wife are not applicable immediately to inheritance tax too. Keep this £1 million number in mind, as we'll be coming back to it later on. But anything above those allowances is taxed at 40%. Now here is the very important part. Until now, most private pensions have sat completely outside of this calculation. Your pension did not count as part of your estate for inheritance tax, which is exactly why so many retirement strategies over the last decade were built around spending other assets first. Your savings, your property income, your ISAs, etc., and leaving the pension completely untouched. The pension was the smart asset to hold on to as it grew outside of the tax net and could be passed down efficiently. But that's all about to change. So let's have a look at what is actually coming in April 2027 and why it matters so much to you. What is going to change then in 2027? Well, from April 2027, most unused pension pots will be pulled into your estate now for inheritance tax purposes. And for many families, this changes absolutely everything. So let me show you how. Imagine someone has a house worth £1 million and a pension worth £1 million. They have 3 children they want to leave everything to. So under the current rules, the pension sits outside the inheritance tax calculation. The tax only applies to the house. So after using the £1 million worth of allowances between husband and wife, that leaves nothing that would become taxable. So at present, HMRC would get nothing. Each of the 3 children receives around £666,667 each, and HMRC receives nothing. Now, let us look at the same family under the new rules that are going to be applied in April 2027. The pension is now included in the estate, so instead of the tax applying to £1 million, it now applies to £2 million. So after the same £1 million of allowances, there's still £1 million that's applicable to tax. At 40%, that comes to £400,000, which goes to HMRC, while each of your children receives around £533,333 each. The government is taking nearly as much as your kids. And it's not just about paying 40% on a larger pot. There's a whole other layer. Remember the nil rate bands we mentioned earlier? To make matters worse, they are also now in danger. Once your estate goes above 2 million, you start to lose some of these allowances. In particular, the £175,000 allowance, which is called the residence nil rate band. So for every £2 your estate goes over 2 million, you lose £1 of that allowance. And until now, pensions were not included in that calculation. From 2027, they will be. Which means a lot of you watching who thought you were comfortably below the £2 million threshold could suddenly find yourselves above it, losing allowances and paying tax you never expected. A £1.2 million home and a £900,000 pension was never a problem before. And from 2027, that will now be over the £2 million threshold. So what does this actually mean for you? And what can you do before April 2027 arrives to protect yourself? So what should you do now? This is not a reason to panic, first off, but you should act now, because the earlier you start, the more options you're going to have. Most people would not ignore a health symptom for years and then be surprised when it became serious. But with financial planning, that is exactly what happens. People wait until something forces them to look. They need to be pushed. Unfortunately, they rarely jump, which is a shame. That could be a death in the family, a big birthday, or a news story like this one. And by then, some of the options are already closed. I cannot stress this enough. The people who come to us early almost always have more options. April 2027 is not far away. And some of the planning that reduces a bill like this takes time to put in place properly. The first thing to do is to look at your estate as a whole. Property, investments, pensions, life insurance, everything together, not separately. We can no longer keep pensions outside of the inheritance tax conversations. The second thing is to understand the taper. If your total wealth, including your pension, is approaching £2 million, you could be entering territory where allowances are starting to disappear. You need to make sure you run those numbers properly. And the third thing is this: do not assume the planning strategies that work before 2027 will work the same way after it. Many retirement strategies were built around the idea that pensions are separate. From 2027, they will no longer be separate. Next week, I'll be releasing another video showing how, under the new rules, it's possible in some situations to reduce an inheritance tax bill by £250,000 or more with proper planning. If you want to see that breakdown, please visit our channel or click on the subscribe button to make sure you get notified when the video is released. This is one of the most significant inheritance tax changes in a generation. It does not mean pensions are bad, and it does not mean your retirement plan is broken, but it does mean that what worked before 2027 may not work the same way after it. You've worked hard for what you want your family to receive. The last thing you want is for the government to end up with more of it than they do. If you'd like to speak to someone about how these changes apply to your situation, there's a link in the description box below to book a no obligation free call with one of our trusted advisors. And if you found this helpful, please subscribe for more retirement planning content. Thank you very much for watching.